Hello and welcome to another episode of Please Help Me Understand. On this show, I will ask some of the smartest people in finance some of the dumbest questions that you were embarrassed to ask. Now, the post 2008 period for our financial markets has been a very unusual period because the markets have pretty much gone up in a straight line. Now, of course, you could point out to the 2013 taper tantrum crisis, the 2015 Chinese devaluation crisis, or the big drama in 2018 when the Fed wanted to hike rates. But if you zoom out, all these events were minor bumps in the market's steady journey upward. Even COVID, which was supposed to kill us all and put an end to humanity, didn't really matter in the end. The markets fell about 40-50% in March 2020, but by November and December, they pretty much recovered all their losses. And it's not just the markets. The post-Cold War period was also a very unusual period for the world because we lived in an era where there was just one superpower, which is the United States, and we had one dominant currency, which is the dollar. But suddenly it looks like things are starting to change. Now, of course, nobody can predict the future, but it looks like we are at an inflection point. Now, the first big event which kind of shook things up was Russia's invasion of Ukraine. And then we had the crisis in the Middle East, and now things are starting to look shaky in the financial markets because of whatever is happening in Japan. So I reached out to Debashish Bose, who's a partner at Oaks Asset Management, and he runs their public markets fund. Now, whenever something big happens in the world of macro, Debashish is always the first person I reach out to because he has a very interesting way of looking at the world and figuring out what's happening and connecting the dots. If you listen to him, it sounds like he's a conspiracy theorist because he's connecting all those dots we didn't think about. But that's what makes him so good because he can see things that you and I are not thinking about. In this conversation, I spoke to Debashish about this current moment that we are in. If we are entering a new world where all the old things have changed, if the markets have changed, if all the frameworks that we used to have changed, and all the other dumb questions that were floating around in my mind, I'm pretty sure they were floating in your head also. So Debashish not only talks about how the Indian economy is changing, he also talks about various trends that are shaping and changing the global financial markets, currencies, bonds, equities, etc. It was an absolutely phenomenal conversation because, and I'm pretty sure you'll have to listen to this conversation twice because there's so much to unpack, and I thoroughly enjoyed this conversation. I know I learned a lot. I'm pretty sure you will enjoy this conversation and learn as well. With that, please enjoy my conversation with Debashish. Okay, Debashish, thank you for doing this on such short notice. So whenever something happens in the markets, the first global macro person that comes to my head is you because we've done those multiple sessions that year. So once again, thank you for doing this on such short notice.
You're welcome.
Okay, so first question, is it all over?
I can't imagine. Can't imagine something which has just started could be all over. But you know, like in everything else, there's a very short-term earthquake which happens, and then the tremors died out a little bit. And maybe over the course of this week, the tremors will die down because some of those moves have been really, really swift. And which is the interesting thing about markets today. Let me put it as that. The adjustments are so fast. It's not like you've got to wait around for a long time for it to happen. So that's there. But definitely, some dynamics have changed, and we can kind of delve into that.
Got it. Before we talk about the entire world, so because you also manage money, and I can't imagine what that must be like. But from a money manager angle, sitting where you are, like if you look at not just the Indian markets, but also the global markets. Like, what's your sense of where we are? And also considering that we have come from, the last 4 or 5 years of pretty much everything going in a straight line. Before we look ahead, like, what's your sense as to where we are and what's your view on, stocks, bonds, both domestic and global?
Sure.
So that will set the level field and then we'll dive deep.
Yeah, no, definitely. So I think, even when we started off, and that whole thought process hasn't necessarily changed today, and we started like in early 2021, the belief always was that, this whole decade and a half is going to be quite a bit of a shift from what the world was in the previous 30, 40 years. Whether it's deglobalization or, say, a state of war. We call it wartime economics, but like a state of war which is there. That doesn't necessarily mean war. It just means staying in a state of war because it is massively beneficial for a certain segment to be in that state. So that's another aspect. Questions being asked about the reserve currencies. A lot of actions from different countries and especially when geopolitics gets involved, geopolitics is not just about a physical war, a kinetic war. It's really about currencies, economies, policies. All of them come into play, and usually in these circumstances, currencies is like the first tool by which to wage war. So our thinking also was at that time, when I look things at a global perspective, things are going to be volatile, come what may. It could be up, it could be down, you'll have opportunities, you'll have losses, all that will happen, but it will be volatile. So from a money management point of view, the thought was, let's stick to mostly investing in things within India.
Right.
In terms of not just, yes, we run a PMS in India, so that's one part, but also into the underlying investments being mostly focused around India. Not to say things happening abroad are attractive or not attractive, but we felt that in a world with this kind of deceptible behavior, currency volatility, when it starts going up, it becomes enormously difficult to predict what kind of earnings will be there for a company which is earning revenues in multiple currencies. Translating it back into, say, your home currency it could be beneficial sometimes, it could go completely the other way sometimes. And so that was a big part of the thought. Another side was that, look, I mean, India's got its own cycle of development in terms of, call it industrialization, or maybe there may be a whole rethink of that also, in the coming days. But call it an industrialization cycle, low income to middle income economic transition. That's what India was part of, was going to go through anyway. But then there's this whole set of things happening globally, which will influence how we go about this change, which will also be sources of generating returns as well, or, risks and all that. So that was another thing we were mindful of when we were going into this whole thing. So the whole idea was, there's going to be a whole lot of variables. How do you narrow it down to a set of things which are relatively easier to think around and try and invest around those? Because when you're managing other people's money, you don't necessarily want to, deal with too many variables. I mean, as it is, you're dealing with a moving price every day. Yeah. So that's the long story short. Of course, each of those things is a 1 hour long conversation, but yeah.
Yeah. Got it. But just quickly picking up on that, like, let's say, for example, deglobalization, I hate the term, but, people keep saying that there are these mega trends. One is, of course, there's talk of onshoring, manufacturing moving away to India, the indigenization angle, so on and so forth. Then there is de-dollarization and deglobalization, like you said. And of course, there's always the geopolitical angle of, somebody bombing somebody and all things going to hell. Like, it's impossible to parse out all the angles and all the potential outcomes of all those mega trends, so to speak. But by and by, do you think some of those things are beneficial for the Indian markets? Like, considering whatever has played, the stock prices seem to be in a mode of their own. Some of these themes, like, power, defense, etc. But broadly, these themes, like, on balance, good, bad. What's your sense?
No, I don't think there's any point in looking at it whether it's on balance good or bad. I'm just saying it is what it is. Right? And we're only looking at a very limited period of history. Like, let's just take that deglobalization as an example, right? Because it's just being called deglobalization because most of our history in everybody's minds is literally about 30, 40 years old, which was a period of globalization. There were several periods of deglobalization prior to that. You could almost make an argument that globalization was the exception to the norm rather than deglobalization. And people typically operated in their own, this thing. Now, deglobalization, after a period of globalization, the only logic to it is that, look, there's somebody that globalization was under the terms of one hegemon. Right. And suddenly you've got this situation where someone else is coming up, probably the strongest challenge the existing hegemon has ever faced. And an old enemy has also joined hands over there, which makes it not such a simple, opponent to take on, both from a military or a economic perspective.
Right.
And the changing reality also that, yes, there was a West, which was, if I were to call it a collective West, which was the developed world. But today, with all the things going on, the large parts of the emerging world where, again, things are changing so quickly. I mean, including our own country. So it's a change. I mean, it's as simple as that. Now, when a change of that order happens, where call it a regime change for want of Game of Thrones regime change, whatever. So when that happens, then there's obviously going to be a shift in alliances, a shift in allegiances, all of those things, right? So a deglobalization doesn't necessarily mean we will stop having imports and exports. I mean, I don't think that's the thing, but it's just that you have a realignment of who you are partnering with for what. So it's the transition. I mean, and that same logic now you can apply on a whole bunch of things. I mean, the hot topic of the day, AI and all that. I mean, look, chances are 20 years down the road, it's going to, probably create a whole set of opportunities which we cannot even imagine today. The issue is from now to 20 years, how do you navigate that? Right? And what kind of repercussions it has. So, or you take currency for that matter. Like currency has always been a tool of whoever was the dominant power. I mean, there were times when the rupee also had its range all the way from the Middle East to Southeast Asia, right? So, and of course, there's been multiple reserve currencies in the world from time to time, depending on whoever was the most powerful nation at the time. So, if you're looking to break sort of, superpower versus upcoming power kind of thing, then putting doubts into what should be the reserve currency is a very legitimate part of the exercise.
Makes sense.
And then when you think about some of the big things which have been talked about, which is either whether it's energy transition, either it is a reset of the supply chain, all of which have got reinforced by COVID or, the Ukraine war, or now all this Middle East things which are going on. Now, these two are also the bulwarks of the existing currency system. The dollar system, because the dollar was pegged to oil and the dollar was broadly pegged to the yuan where they were producing all the goods. Now, once you start rejigging all of this, then you're essentially breaking the absolute roots of the reserve currency system. That doesn't again mean that tomorrow there's going to be an alternative to the dollar. There isn't really one, right? I mean, we all kind of have to get there somewhere, and which the reality of that may only be evident 15 to 20 years out. So, to me, when I look at all these things, it was like we're going to go into this whole period of uncertainty where all kinds of things are changing, and therefore the past rules may not necessarily apply. Past correlations may not necessarily hold. And I think one of the first past correlations which stopped holding was the stock to bond correlation, right? Where stocks used to go up, bonds used to go down. That's gone all over the place. So, So once these things start changing, you can't have too many fixated notions on what's going to happen. I mean, no one knows, right? Exactly. So you can only do a risk reward kind of thing. Like, what is it that people are already positioned in versus what are they not? So should something change, how will the markets react? That's really what you can think around. Okay. Which when you now apply from an investor's point of view, and let's make it even more simple in terms of applying from an Indian investor's point of view, I think whenever these events hit, I think the first question you've got to ask is, what are the options? Right? In the very near term, for sure, like everything is getting, whether it's on X or whether it's on any other social media, this or that, all the news are getting transmitted instantly. So the psychological transmission of fear or greed happens as quickly as it can happen, right? But once you're done with the initial fear and shock and all of that, and then you start thinking a little more, medium term, let's put it that way. I don't think anybody can really think too much long term anymore. But even if you think a few months out, then the question becomes, okay, what are my options, right? And am I going to go back to putting money into a fixed deposit which gives me post-tax 4 or 5% or something? Debatable, right? Or let's just say not very attractive. Even if equities look like falling, where exactly are you going to go, is the question. Yes, gold maybe got just a little more attractive with all that, import duty changes and all. But of course, SGB holders got a little screwed in the process. But that's the thing.
That's sad.
Yeah. I mean, we've owned gold for a long time, so okay, but that's the whole thing. But then, or you look at real estate, but now with indexation and all that going on, I mean, does it exactly help you beat inflation or does it not? Again, we don't know, right? I mean, historically, it was always a shield. It may still do that, but once you've taken the tax shelter of indexation away, it again becomes a different dynamic.
I mean, the benchmark becomes higher.
Benchmark becomes this thing. So again, it boils down to, okay, then what are my realistic options? It again comes down to the same things: equities, stocks, gold, real estate, basically. Or you do your own, invest into yourself, whichever way, whatever that means,
Right.
So that dynamic has not changed. Now, if tomorrow the banks, in their infinite wisdom, decide that they simply cannot raise enough deposits and now need to start offering, say, anything above 9%, I think in my mind somewhere around 8.5%, 9% is like that indifference curve, right? Which is below that doesn't excite. At that point, you're okay either way. But 9+ suddenly starts looking a very different ball game. Then you start thinking, okay, maybe it's worth putting a certain part aside, just in, keep it in that FD and be safe with it. And then a little less money we'll use to do whatever we do. That changes the dynamics. That changes, everything. Or take another example. I mean, this, instrument, again, we've been talking about for a while, which is InvITs, right? I mean, I see the potential for that becoming something significantly bigger. I mean, and not just me. I think the regulator also seems to see the potential. But
they've been pushing for it.
They've been pushing for it. That potential could be significantly enhanced if the tax becomes a little more attractive on it in terms of the interest. The tax
Right now, it's
on the
a bit
interest.
of a mess.
Yeah. Right now, it's a little cumbersome, as well as you're still paying the full tax, so it doesn't. But the other side to it is, once you seriously go down that path of building infra, without necessarily spending as much out of your budgets, because you want to keep your debt to GDP within certain balances, then it becomes the ideal vehicle to channel money, whether it's from retail investors, whether it's from overseas investors. It's a great vehicle to channel money into bigger projects and all of those things. So again, you start changing some of the taxation on it. You bring in muni bonds, for instance, which is basically the equivalent of the tax-free bonds of old, right? You bring those on, give people a tax-free option around that 7.5%. Again, the dynamics change, right? So always evaluate. I would say always evaluate it on that front. That what are my options? And if my options still say equities, then broadly it becomes a buy on dip market. I mean, it's not a slam dunk. Which is what it's been. I mean, it's not a slam dunk, but it's still it's still there. It's probably become easier than ever also to set up a business of advising or mutual fund distribution or any of these things. So many platforms have come up. So much has changed in the last few years. So I think that's the reality we just live in. Till that changes, I mean, if you think about it the other way, this whole bull market also really took off post March 2023 when they changed the rules on debt funds and the taxation and all that. It essentially made equity the only game in town. So that's the way to look at it from the other side.
Got it. So the other pressing question, which pretty much is on everybody's mind, considering that one-way non-stop route. Are things overheated? I mean, in the sense that, of course, there's always a valuation angle, but valuations don't return on a dime. They can continue to get overvalued for a long time, and you'll probably be underperforming a debt fund. But if you just take like 80,000-foot view and just evaluate things, and also I'm sure it must be at the back of your mind when you're deploying fresh money coming in. Are things overheated? At least, both in the Indian context and the global context, considering that equity has been the only game in town. Are things starting to look a little dicey?
By any conventional measure, yes. Okay. What do I mean by conventional measure? Like, you look at your P's and your, stock multiple to or market cap to whatever the earnings might be on a projected basis, all of that. Right? It is. The only thing is that everyone can see those conventional measures. It's not that it's missing. Right? Thanks to screeners and whatever of the world, everyone has that data. So,
Right.
So where again I go back to that whole thing that let's evaluate it. What are my options, right? And we can get a little more technical about it. The market P, after this little correction or whatever, is still probably about 21, 22 times, give or take, broadly.
Yeah, at least
Okay.
the large caps,
Let's say at a market level, headline level, yeah. Small caps could be a little more, but maybe more because of illiquidity than anything else. But let's say it's there.
Blended, we're not too wildly overvalued.
Too widely, exactly. So 21, 22 times. Now, if you invert it, like 1 upon 100 upon 21, 22, whatever, 1 upon, that, which is basically earnings yield. If you invert P, you get earnings yield, E by P.
Yeah.
So E by P roughly will be about 4.5, 4.6% or something like that, right? E by P for the market. Now compare that with post-tax bond yields. And you roughly come to the same number, assuming you are in the 30, 35, 40% tax bracket. It'll be a slightly higher number if you're in a lower tax bracket, but let's say roughly you're there. And again, we know like 80% of the money is basically coming from the higher tax bracket folks. So when you're there, it's sort of, there's a bit of a balance actually when you look at the earnings yield from the stock market versus the post-tax bond yield. It's about the same, 4.5%, 5%, right? On a post-tax basis, right? So which is why I go back to what are the alternatives. If there are alternatives which give me a post-tax yield of 7.5, 8%, that changes the dynamics. Then 21, 22 PE is not justified. It should be closer to a 16, right. 17 PE or something. Now, 16, 17 PE, you can either basically, the market can go nowhere for 2 years, which is also possible. It may do up and down, but it may actually go nowhere. And you sort of, grow into that number. Or it can have a faster correction and we kind of just get there. At which point, again, people start jumping in and all that stuff happens. So that's the simple, if you were to put it on a dashboard, this is the simple thing you've got to look at. In the current scheme of things, where is the alternative? So you'll kind of, go with that. And therefore, your base case becomes that, yes, any corrections will probably get bought right now because people simply have nowhere else to.
Been the case so far.
Yeah, people simply have no real alternative. Or at least no real alternative is they are excited about.
Got it. So if that's the case, like the one problem with conventional measures, and many people have pointed out, is that you're anchoring your long-term averages to a period which was decades away, and the market was different, the market structure was different, taxation, regulation, policy, the entire world was different, which means that long-term averages are probably not the right benchmark for you, and they should probably move slightly higher to accommodate the fact that we are in a new world. So does that argument make sense in your mind?
It does, because end of the day, so there are two aspects to it. One is who is buying or who is not selling. Markets move up because people are not selling, and they're not selling because they have nowhere else to put it. So while there is a long list of buyers which is still there, who's generating this money and trying to figure out where to put that money. That's one angle. The other side to it is, what if there are actually structural changes happening? What if all the things we are talking about, that we do become a bigger manufacturing destination, we do have agriculture becoming far bigger, all those things, which get talked about.
Right.
Should that truly happen? And should we truly become, one of those bigger economies and all those things? Then, the past again doesn't matter so much, because you're literally talking a new paradigm or a new, kind of dynamic altogether. Which is where all these geopolitical angles also start getting interesting, because to give you an example, now again, this may not necessarily happen, but I'm just giving an example that let's say, a debate going on currently in all these US military establishments and all that is that the amount of logistical support and the sort of, you're making all your weapons and your, all the production of all those items, defense production, that kind of size of facilities is simply not there to sustain a war for a long period against China and China's proxies, right? It's simply not there. It doesn't exist in the US, and you'll have to be, how much can even a Japan and Korea, which is the allies and all that, produce to get there? And does it even still match anywhere close to what China's capabilities are of production? Right?
Probably not.
Yeah. So then it suddenly becomes an interesting segue for us to sort of, raise our hand and say, look, we're here to, provide you capacity. And we can scale that up and give you that ability to do it. Now, what's interesting is historically, you go back all the way till from whenever development has happened in mankind at every point in time, it's always been linked to wars. Wars force development to speed up, or even scientific advancements have been linked to war. So suddenly, because of all this situation, on our own, we probably wouldn't have got there. But suddenly, because of the situation, we may be in a shape to,
it's
kind of
very
get
paradoxical.
there. Yeah, exactly. Now, that may or may not even be necessarily the thing we were even planning, but it's just maybe happening, So these kind of things, when you're talking about these paradigm shifts, they're not so easy to capture in your valuations and all that. It's basically been the easiest example for this is to just look at the US markets over the last 15 years. At various points of time, if you were buying all those... They've always been overvalued. Yeah, they've always been that. And you take all of those stocks, the Teslas, the Facebooks, the Googles or whatever. Maybe not so much Apple simply because, it's more a physical product and all that. But all of those were always hard to fathom.
The software majors at least.
Yeah, it's always hard to fathom that how are they sort of, but that's kind of what it is. That's what we're dealing with. Now, a third angle, which is an even bigger...
We have all those... So if that's the case, so one, we have all those big shifts that we have spoken about, everything from geopolitics to the changing structure of the market itself. Two, we've had this relentless rally, so to speak. If you the COVID blip always is an aberration in my head, but let's remove that. So we've pretty much had nearly 12, 13 years, however you slice it, of almost one-way journey in one way or the other. But suddenly it looks like that COVID was in some way or the other, it probably brought all those things which were hidden underneath to the fore, from supply chains to geopolitical rivalries to those old valuations, correlations, everything has suddenly changed. And it feels like day one of an entirely new market history, so to speak. And does that mean whatever frameworks, whatever thought process that you've used, whatever heuristics you used to rely on, in the sense that do investors need a new playbook to navigate what's to come? It certainly feels like that. But then again, there's also the other side of the argument. Everything feels unprecedented in the moment if you're living about it. So how does one think about the current situation and considering the very sort of uncertain world that we are in?
No, absolutely. And actually, it's an absolute on-point question, which is, the only way you can try and unpack this level of uncertainty is to kind of try and break it down into different components, right? So break it down into the global side, break it down into the domestic side, and then figure out what your time frame of investment is within that. Now, if your time frame of investment is extremely short, essentially trading futures and options, all of this should not matter. You should not even bother listening to this and stick to, the relevance of the price and the action and all that. But if you're thinking a little longer and trying to figure out your investments, then yes, there are 2-3 angles, break it down into that. So one, like I was mentioning, this whole global thing. Now, fact of the matter is we are in a battle for supremacy of the world, for want of a simple this thing. And that will always mean there'll be dynamics on both sides. Somebody will fire something, somebody will come back with something else, and this will be an ongoing feature, right? So, And like I said, I mean, these policies will go beyond just wars. It is about, using currencies as your tools, using, like to give you another example, I mean, China's put so much behind, building their EV ecosystem, right?
Right.
Now, because of that, if they're allowed unbridled access to the world, they will literally clean out every other automobile company in the world.
Seems to be happening so far. Yeah.
And what have they responded to it? They've gone ahead and put all kinds of tariffs on it, right? Duties and all of them. US, Europe, both of them. I mean, Europe's talking some 40%, US talking some 100% duty, and all those kind of things are there, right? Now, how does China then respond to that? Okay, let's get a little weaker currency and, still bypass all that. So what do they then respond to it? Okay, the Chinese currency gets weaker because it's sort of correlated to how the Japanese currency also behaves, because they're all exporter currencies. So if the Japanese currency is getting weaker and weaker, the China gets the room to get weaker, and you can then compete. But then they suddenly shift policies on Japan so radically. Exactly when, till now, right. The Fed was increasing rates, other banks were increasing rates, Japan was decreasing rates or keeping it right there.
Now it's flipped. It looks like it's flipping.
Yeah, it's flipped. I mean, basically they flipped it. And the timing of it was exactly when the Chinese plenum finished. And they came out with their this thing of doubling down on, all the strategic sectors. Yeah. So it can't be a coincidence that it happened almost exactly at that time. Yes, some hedge funds might have got laid out in the process, but that's literally what was going on. So these dynamics will keep shifting. I think just go with that assumption, which is why, I mean, my own strategy was let's not try and invest in too many places around the world because there are too many variables to deal with. Let me just focus on what is India and broadly driven by what is happening in India. That was a thought process. Now, others could have different thought processes. It's just a function of how are you set up for that. Second, let's look at India. Okay. Now, India normally also was in that industrialization cycle. The playbook for industrialization has been remarkably similar across in the last 400 years, which is build factories, people move from the rural areas to the factories, urbanization also happens, industrial townships come up, infra has to be built, all of that. All these big 4-5 areas are also where job creation, the mass level job creation happens. And then over a period of time, as people move out of agriculture, then agriculture also starts modernizing. So that's the broad playbook everybody followed, which is take people out of agriculture, put them into industries, and over a period of time, they'll also move from industries to higher end services, and all that will happen. Now, two things have come up in this. Now, this is the normal thing. This was also what they completely reiterated on in the 2021 budget, just when we were at that peak of COVID, that we'll go ahead, do a lot of this, funding, infra, funding logistics, boosting manufacturing, basically this playbook, right? But now again has come a time to do a bit of a rethink on this. The reason is, on one side, yes, there is this whole thing of how big a manufacturing destination we're going to become and all of that. I mean, there's a lot of hype about it. Now comes the reality part of actually executing on it. Now, who's actually going to put the money when the time has come? Yeah. And what one is finding is, yes, companies are investing and they're doing it, but it's not like they've gone absolutely crazy trying to do it. And the reason also is that there is a massive amount of manufacturing capacity globally available. Both in terms of what China already has, and it's doubling down on that. And secondly, also that a lot of the West is also looking to set up its own manufacturing capacities. So rather than...
Industrialization is in vogue right now.
Everywhere. So which then means that if you're an entrepreneur trying to put that up, you truly are not very sure that, okay, is there going to be an export market for me at all? Right, between the geopolitics, between the dynamics of each country and all that, is it attractive enough even for me to do it, or is it more attractive for me to go set up a plant in the US, for instance? I mean, one can debate whether it truly is or it isn't, but it's at least all these things are happening together. So, and then on top of that, if China is responding to China plus one by saying, okay, I'll just create many Chinas and you can do as many ones as you want. So you literally expand their own capacity to, I mean, it's basically no different if you think about it to what happened about 7, 8, 9 years back when US shale gas was really soaring. Shale gas, shale oil was really soaring. And what Saudi did was really double down on its own capacity. And because of that, oil prices came down. And when oil prices go below 60, shale gas doesn't, stay viable anymore. So
becomes unviable.
Yeah. So at a time when a lot of people are trying to set up industrial capacity, if our big boy comes and doubles its own industrial capacity and floods the world with its products, it suddenly, takes the viability of a whole lot of industrial capacities out. And this is happening now. So this is not, a theoretical thing anymore. So this puts a bit of a spanner in our own thinking that, okay, do we now still go with that manufacturing to whatever, based approach, which the rest of Asia followed to develop? The second side is again services, and we're talking the higher end services where, obviously the IT firms and the BPOs were the big job creators forever. And that slowed down for obvious reasons. And obviously whatever is happening with AI and everything. Which then means suddenly your two big engines of development are not necessarily, and for us, development is only the word. The real objective is job creation, because job creation keeps you in power, right? So if the two big engines of job creation are not necessarily so, straightforward anymore, whether it's manufacturing, whether it's, yes, you can keep building as much real estate and constructing as many things for a while, and which is fine. That will probably go on. That will keep people engaged, but it's not exactly, it's not exactly aspirational jobs for people. So it's casual,
it's very low
paying, casual, and also seasonal kind of things. Yeah. So a whole body of thinking is now emerging when also tied in with where we've gone wrong with, not we, but in the sense, what has gone wrong in the elections, especially in the rural areas and all of that. Is that there needs to be probably a different approach to our whole developmental model. And instead of agriculture being the outcome of development in industries and services, and therefore, agriculture also benefits, you make it the pivot, you make it the focus. So you actually build agriculture, you keep the people in the rural areas, you don't try to urbanize as much. You keep the people there, but to keep the people there, you've got to give them something, right? You've got to give them hope. You've already been giving freebies, so I don't think that's the answer. So you've got to give jobs, you've got to give hope and all that, which means then you maybe have to rethink your whole developmental model and go completely agri first, which is a big shift in thinking, and it's going to be a big thing for even the market to grapple with. Because suddenly all the areas...
It also sounds very unnatural.
It is, because that's exactly the thought process, that maybe we need to flip this model.
Right.
What was the... And I'm not saying myself, it's actually there in the economic survey, it's right there. It's been talked about.
I think that Raghuram Rajan, he's a hated figure. He also, I think in some loose sense, he had a point when he said probably we're not going to create a manufacturing base.
He may have, yeah. Correct. So anybody who's looking at that China data will also... So like I said, just if you were to think of it from an economic perspective, it may not make much sense. But then there are strategic angles to it also. So strategically, yes, certain amount of manufacturing could probably happen, and maybe you could benefit from this whole tussle. There's also the whole debate has rearisen that anyway we are importing so much from China, may as well let's start importing their capital. Let's allow Chinese FDI at least in certain areas and certain products and all that.
There seems to be a rethink on that also.
Rethink, exactly. So now that may not be the worst outcome from a longer term point of view. Also, if enough of their FDI is coming in, safe to assume they're not going to attack us then. But the other side to it also
is a good deterrent.
Yeah, the other side to it is, because that's the thing about the Chinese. The one thing they love more than anything else is making money. Right? So they're more capitalists than what people think. So they're not the communists which people make them out to be. So that's the thing.
It's a very caricaturish thinking of Chinese economy. Yeah.
So if that's the thing, then that's not very good news for our manufacturing sector, though. Who has basically built a lot on tariffs.
Yeah, so far,
it's not a very this thing. So it creates some doubts, like who works, who doesn't work, and all those things. So you got to think a little around that. If you're flipping the development model on its head, I mean, it's an interesting thought again, whether we execute on it, whether we can, because the interesting thing is that in agriculture, we actually have strengths, which we do not have in manufacturing specifically, apart from just having a big labor force. Like, it's not like we have a huge amount of raw materials and all that. But agri, we actually have arable land, we have multiple climatic zones, we have all that. So we can actually be an agri superpower. So let's see, again, how this plays out. The other angle to it is also that growing realization that, look, all the power can't be controlled with the big companies, which is kind of what had been happening anyway. I mean, you desperately need these medium, small enterprises to also grow because they are the ones who create jobs at the end of the day at a mass level.
And they've gone nowhere for...
They've only decreased. Yeah, they've actually gone down. So, now, of course, in the physical world, I don't think there's any real solution to them. I think the answer will come from the whole digital stack, the ONDCs and whatever of the world as they build out. So that's also going to take some time, but okay, maybe it's a path in that direction. The third side, and that's the more tricky one, and which is not such a great one from a capital market returns point of view, is the whole debate around capital versus labor. Because now this is not just an India debate, this is a global thing. And like I said, maybe...
there it's even more louder than... I don't think we're even having the debate, but there it's
louder. It's louder, no doubt about it. But the fact is that, yes, maybe in 20 years, AI will give all those new paths which we can't imagine. But what do we do for those 20 years? Now, what was very interesting is there was an IMF paper which is actually, being sent out to multiple countries. It's a discussion paper, which actually talks about fiscal measures to be taken to essentially create a bit of a rebalance between the money made by capital asset owners versus those who are employees making incomes.
That is heresy coming from IMF.
It's there. Now, the interesting thing is the economic survey also refers to that paper. And then right after that, the budget comes out where they start with talking about employment-linked schemes, and then they change the capital gains taxes and all of that. So I think the direction has already been set. I don't think this is the end of capital gains taxes being increased, especially on the short term. Maybe long term, they still keep it wherever.
Ouch.
It is ouch. And that's why I said this part is not going to sound good to people. But when you think about it, it's a complex one. I mean, either the vote base of people in the stock markets massively exceeds the vote base who is not making money from capital assets.
Which is not the case at all. It's just 9 crore people versus another 15 crore people. It's not even a balance.
It's not even a balance, right? So till that situation again exists, which side will a politician lean towards? That's your answer.
We are the sacrificial lambs.
That's your answer. So, and that may be the case for a while to come. So that what it does, it actually puts a bit of a cap on what kind of returns might be there. Because today it may just be a nudge to say, okay, hire these interns, hire these extra people, we'll give you some EPF benefit, all that. Tomorrow it may not be a nudge. Tomorrow it may be a requirement.
There's going to be a requirement,
which then means that what are the elements of that requirement? If you're making excess profits, recycle it into something. Your true CSR is creating employment. If you're doing this, create employment. All those kind of things may come in, which means the incentive to show profits is now not that strong, or may not be that strong in such a world. The big shift in Indian markets, if you think about it in the last 15, 20 years, has been the incentive to show profits. We always used to hide it back in the day. Now it's the other way around. It gets injected in. So that changes again some of the dynamics of what happens. That may again not be bad for conglomerates, because they can always find something to diversify into. But then suddenly you may have a bunch of companies which are becoming diversified.
Heft is an insurance policy for them.
It's an insurance policy, but then many companies may start thinking like that okay, let me diversify from here. And so if a lot of our last 15 years of investment thinking has been around high ROEs, high ROCs, capital efficiency, all of those things, what if we need to rethink all that because the incentives are changing or the policies are changing, right? So this opens up another Pandora's box.
Time to burn my intelligent investor book.
It opens up that whole thing, which then, again, like I said, it's not about good or bad. It is what it is. So we just have to, I think, deal with that situation that yes, there is a set of changes which can be beneficial. There are also a set of changes which can put a cap on returns. And then you evaluate it versus, okay, what are your options at any point in time? And I think a certain amount of balance you'll always, I guess, just have to keep between assets. I mean, that's the reality. It's just, in a world where so many things keep changing, I think you'll just have to do that.
Got it. Makes sense. I mean, that's a fascinating map of where we are and what things might look like. Now, if you were to map that onto the markets, so at least one frame of thinking I have about thinking about the last, call it, post-2008 world is that a lot of things underneath had probably built up which policymakers didn't ignored or didn't want to think about. Like, for example, all of a sudden there's a lot of talk about this private credit in IMF, in RBI's financial stability report, etc., which directly ties into the disintermediation of banks post-2000 crisis, etc., etc. Then we'll get to it, which is essentially Japan's role in essentially flooding the entire world with a cheap fundable currency, which is probably causing all the ripples, etc. And then you have the age-old debate of capital flows between the developed world, developing country, etc. So we'll get into that, but let's say, I mean, a lot of people who listen to this are also first-time investors who probably don't have any idea of why bonds matter, why currencies matter, why equities matter, why flows matter. So just a quick overall markets for idiots 101. So why should I pay attention to one, currencies, two, bonds, both domestic bonds and global bonds, and then three, why should I care about the global market? So if you could quickly give a very cartoonish outline of why these things matter, and then we'll deep dive into it and then connect it to what's happening in the markets currently.
Sure. So look, I think the reason they matter more than anything else is all of us have phones and we can keep looking at their prices. Right? That's the number one reason. Okay. The number two reason is that just like in India, you keep hearing this, that how derivatives is so big. Right? And derivatives is trading multiple times of whatever the stock market is. Now, at a very basic level, you can make the argument that the stock market is basically providing capital to companies.
Right.
The derivatives market is basically providing capital to the market itself. It's not necessarily anything to do with the companies at all. Right? So
it's feeding on itself.
Yeah. Now, it's not about whether it's a good thing or a bad thing. It is what it is. Right? But that's true world over. That's true both in terms of the exchange traded derivatives which we see. So even derivatives is big in multiple countries around the world. Even the US has gone to daily options, right? I mean, most of the action is happening there only. And whether it's a response to the 24/7 crypto world or whatever it is what it is, right? Now, what that, however, means is when the size of the financial world becomes so large versus the size of whatever may be happening in the real world actually doesn't matter so much. So obviously what's happening in the financial world matters. And then we've got the screens to track everything in the financial world. So obviously we're going to start reacting to whatever. So there's one principle, which is if you have to panic fast. Right? There's no point panicking when everybody's panicked. Then that's not going to help, because that might actually be the. So if you have to panic fast. So maybe more than anything else, it's a little bit about just following markets around to get a sense how they're moving, and trying to imbibe from that what is the sentiment and the narrative. Like, are people sitting on the bearish side? Are too many people sitting on the bullish side? What is it? What is the narrative? And the price action, obviously, which comes out of it. Okay. then there is a reality which may be happening in the world which may be unconnected with all of this. Like in terms of how the company is actually growing and all that. Now, the easiest way to think about that, like it doesn't matter what business you do. Unless it's one of those, okay, maybe let me correct myself. If it's a business which is completely linked to the physical world, irrespective of what you do, it's not going to grow beyond a certain rate. Right? Because you simply can't, put those pipes.
Yeah, there's a hard ceiling.
There's this thing. If it's a business which is more linked to, the virality of networks and all of those, that can grow at a very different pace. Now, the fact of the matter is the Indian market doesn't have too many businesses of that kind. Right? Those are the kind of businesses which are more available in the USs of the world and all that, the more developed markets, or even to an extent in China and all that. I think there are less of them available here. There will be more over time, but currently there are only so many. So in India, if you have to try and correlate between what is happening in the markets and what is happening in the economies and all, it may not always work because you're thinking in warp speed on one and you're, still working at physical speed in the other. It's not going to correlate so well.
It's a very old school.
It's still a relatively, exactly. It's still a very, dominated by old school companies. Yes, you can get excited by Zomatos and all of that, but again, all said and done, they're basically the old delivery business only, right? So at the end of the day,
at least it has a shiny wrapper compared to
it has a nice wrapper.
BPO gadgets.
Yeah. So, but that's how it is, right? But it could be that 5 years out, almost every company we're dealing with, even within the physical world, is actually driven a lot more by networks and technology and all of that, which can change dynamics, which can bring in, different sort of more exponential growth models into it and all of that. So those are things, there are no simple answers to it. You've obviously got to, dig around and figure it out and trying to identify those, or you give it to some manager to figure that out. And not just because they're running something called an innovation fund. That may not necessarily be the answer.
I was hoping that would come up.
So they will still need to figure that out. Now, till that time, you do all this figuring out. I think, like I said, to simplify it down, just look at any point in time, look at your alternatives. Just figure out your alternatives. Right. Where all can I put my money in? And don't think of it this stock or that stock. Just keep it more simple. Equities versus bonds versus, all of that. Ideally, in this world, if you're also approaching it new and all that, there's one need for you to obviously multiply wealth, right? When you're essentially new. And usually that will always happen out of some concentrated bet in something. Now, the problem is, if you can make a concentrated bet in something which you know yourself, your classic Peter Lynch type of model, that's probably the best thing you can do. Because that way you can, actually see the thing and how it develops and build out, and even have the confidence to buy when, the stock price has fallen, or to get out when, things have got a little too excessive and all that. Right?
Gives you conviction.
Gives you that conviction. Your conviction is almost always going to be missing if it's borrowed on something you have no idea about. Right? So that may be the simpler way to think about it, that, take your money, divide it into two pieces, take that second piece, just do your usual SIPs and, into those basic things and whatever you basically need to, run your house and all those things. And the rest, just figure something out. At some point or the other, the opportunity will come. You can invest a little bit in figuring out how to evaluate a stock. There's no rocket science to it. Just basics will also do the job. But if you broadly understand your area and all that, or it's linked to your area in some way, that's the way to, kind of get there. I could go into several hours of conversations about all these things, but, the asset classes and that. But I'm not sure it'll really... cluttering the mind will help. Yeah.
No. This gives the conceptual starting point for even beginners to think about. Yeah. So now if that's the case, we have all these different markets, and at any point there'll always be feedback loops between one market and the other, etc. Like for example, one dominant narrative right now is what's happening in Japan is feeding into the US bond market, which is feeding into the, again, the currency markets, etc., etc. So, like, if I were to, in the simplest way, think about these feedback loops between various asset classes, why does that happen? And then we'll dive into what's happening with the markets and with what's happening with this Japanese carry trade, whatever, and then, trying to simplify that.
Sure. So the thing when you're dealing with, and what we're basically saying is, dealing with multiple countries, right? And when you're dealing with multiple countries, the first thing you actually have to start thinking is currencies. The asset classes of that country come next. Okay, first it's currencies. Right. After you've, let's say you're investing into a country, what you're really doing is first buying that currency. That's the first, even in terms of the transaction, like when you're taking that money out in your LRS and you're basically buying the dollar first or the yen first or whatever it is. Right? The next part comes, okay, once you've done that, what do you do with the money next? Your money will first probably get parked in some money market fund or a bond or something, right? So after currency, you're buying the bond or some equivalent of a bond. After that, you then figure out, okay, what am I actually going to do with it? Which is, am I buying something in the stock markets? Am I doing a private equity investment? Am I buying some land there, property there, whatever, right? So that's your sequence of transactions. And that's how the correlation also works, which is currencies. Now, currency compared to any other asset class is a bit different because currency is always quoted in pairs. If you're buying something, you're selling something by default. Okay.
So USD INR, if I buy USD INR, I'm short INR.
Effectively, when you are buying any other asset, also the same thing is happening. Let's say you're buying a bond. Right. A bond has a value, but that value is denominated in that currency. Right. So you're buying, say, $100 worth of bonds. Now, tomorrow, if the value of the dollar collapses, hypothetically, okay, the $100 worth of bonds becomes this thing. But assuming the rupee does not collapse, then your value in one is something else, and your value in something else is completely, gone somewhere else. So these are all where the linkages happen. But there is a very basic linkage between bonds and currencies, which is that if, let's say, US interest rates are 5% and our interest rates are 7%, then it would make sense theoretically to borrow money in dollars and buy our bonds and get 7% on it, because you pay 5%, you get 7%. Right?
So in the simplest term, this is a carry trade.
This is a carry trade. Okay. Now, the only thing is that you're never going to get a freebie like that. So they will, usually the bond is quoting at 7% because typically the Indian currency may be depreciating 2% a year. Or let's say your cost of hedging the Indian currency back to dollar is about 2%. So it'll always be balanced. So when you're doing a carry trade, typically, the only way you'll actually make money is not bothering too much about the hedge, or only doing a partial hedge or, from time to time, an opportunistic hedge or something. Which is why when it unwinds...
YOLO trade, as the kids call it.
Yeah, exactly. So when it unwinds, therefore, it also, sparks a whole... So you had from Jan 2023 till June of 24, you had the yen moving from 120, USD JPY moving from 120 to 160. Then basically in a week, it's moved from 160 to 142 or 143 or wherever it is. So it's literally reversed half that move in...
That's a very sharp move.
Yeah. In like a week. And that's broadly that would have been happening because people would have been unhedged on it because it was a free trade. Right? You were just one-way trade going that way because your policies were completely different. Your interest rate policy. Now, central bank policies only actually delve into the short-term rates. They don't go into long-term. But the market works on the long-term. But the market's long-term rates will reflect what the vision of the, or whatever the policies of the central bank and all that, or the view of, economic growth versus recession, all those things are. So that's why these two things are always sort of, joined at the hip, currencies and bonds. Then come the other asset classes, which is whether it's equity, whether it's real estate, whether it's, whatever, some private entity you're owning in that country, whatever it might be. So those will happen separately, where once you have figured out, okay, you want to be owning this currency and you're comfortable with the regime over there, then you decide, okay, do I want to buy those stocks? Is there an interesting opportunity? And so on. And obviously you would want the value of that stock, for simplicity, to move higher than the potential depreciation of your currency against that or whatever. That's the only reason you'd buy it. Right? That's what you're betting on. So that's how this whole chain is linked. Now, what is a bit of a joker in the pack is commodities. Why I say joker in the pack is that on one hand, commodities are not available everywhere. Like oil is only there in certain areas, or a cobalt is only there in certain areas, or a lithium is only there in certain areas. So in a way, it is a resource of a particular set of countries who own that resource. But at the same time, the price of that resource, assuming you price it in a common currency, which is like $1, is the same. Right? And every country around the world also needs those commodities. Right? The degree of how much you need may differ, but you need it. So your price is the same and everybody needs it. Or flip it around, everybody needs it and therefore you keep the price the same. Right? Your price, what I mean here is the price of the commodity itself. I mean, the landed cost and all that may be different based on how much it's getting shipped and all those things. Right? So when you put that dynamic into this, it suddenly makes it very interesting, because it's almost like while the commodity belongs to the country, you're still setting up this whole global ecosystem to make it work. And that's the bedrock of the reserve currency system. I mean, you're pricing it in one currency simply to make it a lot easier to transact, because everybody needs it. Everybody needs oil.
Right.
So you price it in dollars, right?
One single currency.
Exactly. Now this opens up a whole Pandora's box. Because if commodities on one side is an asset owned by certain countries, but required by everybody else, it is strategic. At the same time, it is linked to currencies, which means its implications go beyond just being the physical use of the currency. They go into how the dynamics of the currencies may play out. And if you want to shift the reserve currency, then maybe we need to rethink how we are pricing oil or how we are pricing other things. Okay. Now let me open up another Pandora's box over here. The world is going to, I won't even say generative AI, it is going into generalized AI, right? Or so I've been told. Right?
Yeah.
Now, whatever version of AI it may be, whether it's specialized, generalized, this, that, the fact is what you'll truly need is energy.
Right.
Massive amounts of it. And then the question becomes, and now energy could be fueled by various things. I mean, various commodities could fuel that energy. You'll also need a lot of these new materials to fuel that energy and so on, because you want to go all sustainable and everything. So now in that dynamic, what becomes the true, at the same time, what AI is effectively doing is basically taking the price of a human down to zero. AI plus robotics, right?
Yeah.
Now, if the price of the human is down to zero, what you're really worried about is the price of running the AI system. The price of running the AI system is the cost of energy. So should you be trading now energy as the reserve instead of? So should you be pricing things in kilojoules per hour or whatever the metric is? Now, again, what I'm talking seems completely nonsensical, but the beauty is science fiction movies always talk about these things prior to reality happening.
Yeah. It's fiction first, reality.
Fiction first, yeah. Fiction has always had, you trade energies through that little dial in your hand and whatever, right? So these are, now again, why am I touching on this? Is that when it's a world where all these things are coming up for question, that what is energy, what is AI going to use, what is, how do you price it, which currency and all of that. And then if suddenly you're getting to a world where you're saying, okay, we are de-dollarizing, let's say.
Right.
But de-dollarizing and then going where, right? Nobody has an answer, right? But when you don't have an answer, what you will typically do, the way to, again, think about it, to simplify it, just like we said, let's think about equities by just simplifying it. What are my alternatives?
Right.
So think about this in a way that, okay, if I don't have money, if tomorrow the RBI just said rupees are worthless, right? So any money we have in the bank is completely useless, right? Your question then becomes, what do you do? What is your reaction function, right? The first thing will, of course, be let's try and secure food and water, right?
Yeah.
Let's assume the government is provided for that, for simplicity, okay? But then after that, your real worry becomes that what do I own now which will preserve value?
Yeah.
I mean, what will create value though is now out of the window. You're just trying to make sure.
I just need something to
preserve.
Stabilize my purchasing power.
Yeah, to preserve value, or even to lose very little if be.
Yeah.
Then what do you start doing? What will you start owning? Right?
Buy Bitcoin.
You will buy some gold, you will buy some property, you will buy some art, you'll try to find things to do it. And
right.
When you start thinking at a country level, what you'll then go is, okay, let me go buy these assets, these natural resources which I need. I mean, I need all this for my development. Let me buy all these things. So now suddenly there becomes a strategic nature to it and a financial reason to own these assets. Now, this has massive implications in this cross-asset mix I was talking about, because, like I said, the first thing was always currencies and bonds. That's what you did.
Right.
But now what you're really doing is the currency is worthless. And if the currency is worthless, the bond is equally worthless. So I am now directly going and buying the resource itself. But the volume of money which is there in currencies and bonds is of the order of several hundred trillions. The volume of money which is there in commodities is not even a trillion. I mean, maybe a few trillion at best. I mean, gold will be, say, about 3 trillion, but maybe a little more, but whatever. I mean, it's nowhere close to hundreds of trillions. Let me simplify that.
It's not a direct
It's not
replacement.
You could also go and buy a certain set of stocks which you think will hold value, or companies really. I mean, you're still thinking companies here. You could do that. Now, once you do all these actions, what you're really saying is, okay, oil priced at 80 to the dollar, or say XYZ company available at whatever, $50 or whatever, the dollar is irrelevant now, because the denominator does not matter. It could be priced in like a gazillion dollars also, because the dollar has basically gone worthless, right? Or you're saying, okay, I'm pricing this stock but the unit of exchange, or the value or whatever is, say, a kilojoule of energy or a barrel of oil, hypothetically. So this stock costs 5 barrels of oil. That's how you start thinking on these angles. It's very complicated. I mean, there's no easy answer to this, but
that would be an interesting world.
But that is a world which is a transition world. A transition world has this confusion built in. I mean, you may still use a particular metric. You may just call it a unit, like how electricity is traded in units. Now, nobody truly knows how to calculate all this kilowatt hour, gigawatt hour, this, that. You just say, okay, we bought, our consumption is 1500 billion units a year or something like that, or we traded so many units. So you just do that. But then what is that unit? Is the question here.
And the unit of denomination.
And we already have that in commodities. Like, you'll see that, when they're measuring gas prices, they will have that BTOE and all those things. And then it's basically equivalent. It's oil equivalent.
Yes.
So all those linkages are there, except it needs a spreadsheet to figure out, what is what.
Just like those conspiracy theory movies have those walls with those plot outlines with those yarns pinned around that.
Correct. So what the dollar always did was brought it all down to one single unit in which you could measure it, like one single price.
Massive abstraction over the entire global financial commodities bond market, so to speak.
Yeah. So once you start breaking that, then that's what you're dealing with.
Yeah. Got it. Now that makes sense. Like if the predominant reserve currency's status of being a reserve currency is under question, that means there's bound to be discord, there's bound to be instability. If is that really one of the reasons why whatever is happening in Japan, etc., with these imbalances winding up, etc., does it directly tie into what's happening there, or is just one of those odd events which probably happen at regular intervals?
So now I may be wrong in this, but my thought has always been that Japan does what the US tells it to do.
Right.
So
which has been the case.
yeah. So this action may also have been just that scenario where the US used it as a counter retaliatory measure to China doubling down on manufacturing and kind of creating a weaker currency and all those things. It may just have been that, right?
Right.
What Japan effectively did is, so far what they were doing was protecting their bond market and letting their currency market go. They flipped it around to trying to protect the currency market now and letting the bond market open, or letting it go in a way. Because what they're saying is, okay, we'll increase our acceptable band for the interest rates, and we will also follow a program of reducing the bond buying. Now, for a country which has 350% debt or whatever it is, even if most of it is owned domestically, that is a dangerous policy. So how long they can truly sustain it may be a little question.
Right. And this was what people were pointing out when the central bank started intervening in those currency markets, spending whatever God knows how many billion trying to prop up the currency. But doesn't this also hurt them in the sense the yen going up is bad for their export competitiveness? Does that factor into this?
I mean, it is, but that's if you look at it from the context that they were at 120 about a year and a half back, and they're still at 142. So on the balance, they'll say that's still
it's a wash.
It's still okay. I mean, he's just talking a major currency basically depreciating 50%. I mean, which is what had happened.
Right.
So maybe 145 is the new 160. I mean, maybe. Or what could be an even bigger head spinner is if the currency weakens and goes back to 160. Despite those policies, then you truly have to start deciding what do you want to save. Do you want to save the currency? Do you want to save the bond markets?
Right. Got it. So, what are some, if I were to just at a very abstract sense think about this currency loop flowing into the, you've outlined several, but at an even higher level, how does this entire imbalance in this currency bond market, why is it flowing to the global markets? What's the dumbest way to think about it?
You mean why is the currency affecting global markets?
What's happening within the, whatever is happening with the yen, why is the entire global market suddenly acting like
so what happens is, whenever a currency does like a one-way move like the way the yen did, okay, right. It just makes it a very simple way to borrow money and deploy it in any asset. Like you just borrowed in yen, or effectively were long USD JPY, which means you were short yen, long dollar. And then you use that dollar to basically go buy anything. You kind of made money. Right? Now anything is, of course, a very vast thing. Now, what just market action has told us, a lot of that anything comprised Nvidia, it comprised Apple and whatever, So, Microsoft and all those things. Yeah. So the anything unwind is usually the unwind of that.
Right.
Because essentially the whole markets, if it's sitting short yen and comfortably sitting short yen, which means not too many people would have bothered hedging it also too much. And you're buying other things, then suddenly this is effectively like a margin call on the yen. Because the yen has started going up and you're short. So when that happens, then automatically you have to start unwinding. Now, others also know you've got those positions, so they'll climb onto it. Your classic short covering based margin selling, all those things.
Right.
That's what it is. So yes, it takes a little bit for that whole thing to maybe stabilize, and obviously the yen itself has to stabilize for that to stabilize. We may be there almost. We may, kind of be there, but that, Does that necessarily mean that volume of money is going back into Nvidia or not? That's a different matter. I mean, that I don't know the answer to it.
Because that will be good for our markets also.
But that's the important part, because I've seen a lot of worries about US recession and all those things happening. Now, maybe there is a recession happening, maybe there's not. I mean, no one again truly knows.
Right.
It's almost like, yes, because of the political reasons, you want a rate cut to happen. And a rate cut cannot happen in markets which are flying. You have to have at least some element of fear built into it.
PR.
Yeah. So maybe that's all there is to it. But who knows? But that's the whole point, that if the interest in that market reduces for whatever reason, then yes, there is an opportunity for more flows to happen to other markets, other stock markets that happens. But also, let's also be mindful of the fact that what you're buying in the US is so radically different than what you're buying in India, that it may not...
Venus and Mars.
Yeah, exactly. So it may not always be so simple an answer, that this is exactly what's going to happen and all of that. And so we'll see. We'll see how that goes.
Got it. I think that's a perfect note to end this conversation. We'll see. Got it. Thank you so much for taking us through this. A lot of
lots of things
counterintuitive and unnatural ways of thinking it, because this is not. I've heard you multiple times before, so I have some sense of it. But for most people, they are still used to thinking, put your money in 3 baskets, valuations, your old Benjamin Graham's, Buffett's, etc. But I think I have a feeling that we are entering a world where all of those things will need, if not total outright rethink, at least subtle tweakings to those mental models.
Correct.
So thank you so much for
You're welcome.
enlightening us.
You're welcome. All right.